Hey everybody, this is chapters 9 and 10. This is where we introduce the balance sheet. And I thought I would just, like we did for the income statement when we first introduced it, just kind of take you on a little tour of a balance sheet. This is a company that many of you know and probably very few of you love. It seems like we all love to hate these guys. They are really good at what they do, but not everybody agrees with their methods, I guess would be a good way of putting it. This is a Walmart company. They are the biggest retailer in the world, and whether you like them or not, you can learn something by looking at their balance sheet. So the first thing I'd have you notice is right here that all numbers are in thousands. That means we're going to add 3 zeros to the end of that number. So for an example, if we were to look at their total current assets, it looks like 63,278,000, but we add 3 zeros to the end of that, that would be 63,278,000,000, giving you a total assets here of kind of a whopping $203 billion. So this is not a tiny little company, and I think everybody knows that. Anybody who's ever been to a single Walmart knows that just the amount of assets sitting on the shelves in one Walmart store is a pretty big number. So let's take a look. So the balance sheet summarizes the assets. Those are the things that the business owns. The liabilities, those are debts owed by the business. And the stockholders' equity, which is a little confusing, but what it is, it's the difference between the assets and the liabilities. A little basic accounting for you is that assets equal liabilities plus equity, or the assets, what a company owns, equals its debts plus its equity. That means that the equity really represents the amount of the company that is owned by the stockholders, or the owners, rather than owned by the bank or the people that lend money to the business. And so because assets equal liabilities plus equity, we'll expect that this number, total assets, will always equal the sum of the total liabilities plus the total stockholders' equity. We could check that if we wanted to, just to make sure, because sometimes, as one of our students found out in the income statement section, sometimes these financial statements put out on Yahoo or MSN Money are a little funky. They don't always work out perfectly. And maybe a better source would be just to go straight to the company's financial disclosures in their quarterly or annual report. So let's just double check this and see if our total liabilities of 122,312 plus our total stockholder equity of 81,394 add up to 203,706, the same as our total assets, and they do. So that is a good sign that we're on the right track. Okay, so let me kind of take you through this. First of all, our assets. Remember, these are things owned by the business. And so Walmart has current assets, which are assets that are either cash or that will be easily converted into cash, or that we expect to convert into cash in the next year, usually the next operating cycle of the business, or a year, if we're not sure what the operating cycle is. And then there are long-term or non-current assets that are longer term that we don't expect to turn into cash quite so easily. So let's take a look. Walmart has cash and cash equivalents of $9,135,000,000. They're not listing any short-term investments. They have receivables. This is money owed to them usually by customers. We know that the average retail customer of Walmart doesn't get credit from Walmart, but perhaps in some of their business-to-business transactions, they do extend credit. Here's a big number. All right, this is the inventory, so $45 billion worth of inventory at Walmart. That is stuff sitting on shelves, sitting in warehouses, sitting in the back of the retail stores, and I bet you at this very moment there's a fair amount of stuff on trucks being shipped from the warehouses to the retail stores. And then other current assets, those are other assets that they believe are fairly liquid, meaning they'll be turned into cash within the next year or so, that they can't categorize as any of these larger categories. So the total current assets are $63,278 million. Then we can look at their long-term or non-current investments. The long-term investments are often things like the stock of other companies, or it could be purchases of land that the company is not actually using for operations right now, but that they expect to resell in the future, something like that. Walmart doesn't list any long-term investments. Property, plant, and equipment, that would be things like buildings, things like trucks, things like any other equipment. It could be forklifts, all sorts of things. That's a pretty big number, and we'd expect it to be for a company the size of Walmart, $116 billion. Goodwill is actually a little bit more of an intangible thing. It's not an intangible asset. It's listed as goodwill. It's a separate thing, but it's a little hard to put your finger on. Usually goodwill is calculated when a business purchases another business, and the difference between the value of that business's assets and how much they paid for it is called goodwill. So if I bought a retail location for my business and an appraiser valued it at $100,000, and I paid $200,000 for it because that was what the market bore, then we'd say that $100,000 worth of that purchase was for the asset itself, the building, and the other $100,000 was for the value that was vested in there having been a store there already. That's what goodwill is. It's a little harder to understand. I wouldn't worry about it too much. Intangible assets include things like patents and copyrights. Accumulated amortization would be any value that had been subtracted off of those intangible assets as they were used up over time. Since they had no intangibles listed, they also have no accumulated amortization. And then other assets. These are assets, again, that don't fall into any of these categories. It's a pretty big number for an other, right? $5.67 billion. So the total assets of Walmart are $203 billion, $203 billion. Look, when you get into numbers like $203 billion, then you just like round off and say, that's $706 million, doesn't really matter. In real life, we know it does, right? I could do pretty good with $706 million. Anyway, 203,706. So that's the assets. Next, we have the liabilities. Again, there's current liabilities and then non-current, or sometimes called long-term liabilities. So the current liabilities of Walmart include their accounts payable. That is money that they owe to vendors usually. And we would expect, again, with a store as big as Walmart, or a company that owns stores, that they would have a fair amount of accounts payable all the time. In this case, they have $58.58 billion. And then they have other short-term debt or current long-term debt. Current long-term debt just means the portion of your long-term debt that's due within the next year. Think of it if you owned a house and you had house payments coming each month. A portion of that debt you have on your house, a portion of your mortgage is long-term in nature. In fact, most of it is, more than a year before you have to pay it. But there's also a portion of it that's due within the next year, those next 12 payments of principal. And so on our balance sheet here, we'll list the current portion of long-term debt. That just means long-term debt that they're going to have to pay this year. So right there we can see that they've got about $65 billion in current liabilities, which is actually a little higher than their current assets. So that's a little bit scary in many businesses, although a business like Walmart that we know is going to have just a ton of retail sales, they should have no problem paying that current debt. Long-term debt, so those are bigger notes that don't have to be paid in this immediate year but are coming up over time, $43 billion. Other liabilities, they're not listing any. Deferred long-term liability charges, this is one of those line items that it looks like they have some expenses on their long-term debt that they've deferred to future periods. It could be interest or fees. We'd have to read their annual report to find out exactly what that means. and the same with minority interest. That probably has something to do with their holdings of subsidiary companies, but again, we'd have to read their report to find out exactly what all that entails. So now we see their total liabilities is $122 billion. The last section is a stockholder equity section. Stockholder equity represents the amount of the business owned by the stockholders. Usually, that is broken down into only a couple of areas. One is what's called contributed capital, or money put into the business by stockholders or owners. When the original purchase of stock happened, that would be financial contributions into the business. So that's listed as common stock. In this case, Walmart has $323 million in common stock carrying out its balance sheet. And then the other is retained earnings. Those would be profits of the business from previous periods that had not been paid out ever to the stockholders. And so you can see that's where the vast majority of Walmart's stockholders' equity comes from, is through retained earnings. There's some other line items here. Preferred stock is just a special class of stock that Walmart doesn't have any of apparently. There's also redeemable preferred stock. Again, those are special classes some companies have and some don't. Miscellaneous stock options and warrants. Those are things given usually to stockholders or members of the board of directors or senior management that allows them to purchase the stock of the company at a given price or something along those lines. But again, they're not listing any on their balance sheet here. Treasury stock would be stock of the corporation that the corporation has bought back from the investor pool and is holding for whatever purpose. You can see again that they don't have any. A capital surplus is an amount of money that was raised through the sale of stock that was in addition to what the par value of the stock was. So really, if you want to see how much the owners paid in when they bought the stock from the company, you would add together the capital surplus and the common stock line items. Oftentimes, capital surplus is listed as something called additional paid-in capital. Those two terms are synonymous. Don't worry too much about it. You don't need to become experts in this. Just know that the capital surplus and the common stock together represent all money that the owners have paid into the company over time. Usually, each time the company itself has offered shares of stock for sale. That's not the same as someone going and buying stock on the market. What they're doing there is buying shares of stock from someone else who's already bought them from the company. It's only in the initial public offering where people are giving money to the actual company to become part owners of the company. And then finally, we have other stockholder equity. In this case, it's a negative $7 billion. Again, that's an unusual line item, and I'd be interested to see, you'd have to read their annual report to see what that number is comprised of. Many companies don't even have that line. You don't see it all the time. Anyway, so there is the balance sheet of Walmart. Again, love them or hate them, they are a gargantuan company, and hopefully this little tour of their balance sheet will help you understand the other balance sheets you're going to look at during the next couple of chapters. I hope this was valuable to you. As always, don't hesitate to contact me if I can help you or explain something or anything. Just let me know. Thanks a lot and have a great week, and I hope you're enjoying learning about the financial statements.